Jamir, welcome and thank you for joining our call tonight. It's always exciting to see you. Today, I want Jamir to talk a little more about amortization. I want to know, why is it important? How does it impact if you are underwriting the property? Would that be one of the factors that you would factor in?
Yeah, absolutely. Because your amortization is going to let you know essentially how much you're going to be paying. You can't underwrite like from a lender's perspective, and lender meaning private money, hard money, uh, bank, anybody who's lending you money. That amortization is going to be the key because that's how you base the loan off of. So when we talked about it, we were talking about amortization and loan term and what the difference between those two are. Let me ask you a question. What sounds more appealing? You're buying a new home and you're getting an amortization of 30 years, or you get an amortization of 50 years. Which would you take?
50.
Why?
Because it sounds like I can spread out my payment. If I cannot afford the house and if I can make, let's say I can only afford $1,000 per month, then I'm thinking I can pay $1,000 for the 50 years. If I pay 30, then it's gonna be maybe I have to pay 1,500 or even 2,000 just to shorten the period.
So you get why amortization is so important without really understanding why amortization is so important.
But that is it normally in the OM or no?
So with a OM, usually a OM is for a commercial situation. Like a 50-year loan, that's not typical. Like nobody's really basing you can, I'm not saying you can't. Uh, and that's where kind of creative financing can really come into play because you can change the amortization. They may say, like, what? Like, I'm going to be dead or whatever the case may be. But it's just like, okay, like I've heard Pace Morby saying he got a deal doing this. Okay, like you may be dead, but your children can
Your
get the money.
generations, yes.
Right. So, like, just like you said, a 30-year amortization versus a 50-year amortization, this is just figuratively speaking, that could be a difference of $500 a month,
Hmm.
right?
Yeah.
Now, that's looking at it from a short-term perspective. Long term, you end up paying more money. So if that's something that's a concern for you, you're going to be paying more money. Why? Because of interest. That's how
Hmm.
banks make money. That's how lenders make money, off of the interest, not off of you making payments. So, all right. So now going back to the difference between amortization and loan term. Loan term is usually seen when you're talking about either you're doing creative financing, in which you potentially are going to have a balloon and you're going to need to refinance that money so you can cover the balloon, and for commercial real estate. And we're just talking about real estate right now. Now, the difference between them is your amortization that directly affects what your payment will be. Your loan term does not. Your loan term says this is when this agreement stops. So if you have a loan term of 10 years on July 17th, if we close on today, July 17th, 2036, the loan agreement is over. But the amortization is what affects the payment. The loan term does not affect the payment. So kind of
So
think of
is
it
long term is just a duration, is it?
exactly. It's the loan term is the how long are we in this agreement for? But when you're purchasing a residential home, there is no long term. It's just the amortization period. That makes sense.
Like Precious says, if the loan terms, think of it like lease terms. Is that correct?
Like lease terms, yes, you can think of it just like a lease. Because okay, I signed a lease. Let's just say I personally am a tenant of a multifamily apartment building. My lease is for 12 months. Okay, I know 12 months from the day that I move in, I have to either I have to either move out or I'm going to sign to continue my stay. The only difference with a loan term is there is no opportunity to sign and continue with this loan payment. You have to refinance or you pull out of the deal itself. And usually that's kind of how it goes if you are a cash flow investor. Usually they're in the deal for 5 to 10 years because they're looking to sell this. They're looking to sell this, the increase, multifamily specifically, the increase in the rents, and which increase the NOI, and hoping that expenses do not outweigh the income in the long term. And then I'm going to sell it to somebody in the public. Refinancing essentially would be renewing the lease in a nutshell. In a nutshell, yes, and that's a very simplistic way to say it. To get more specific with refinancing is you're pulling money out of the deal so you can cover the debt. Now, and you also plan on essentially staying in, you're essentially you're wanting to keep the property. So, okay, we have an exit strategy 5 years. That doesn't mean that the loan term is 5 years. That just means that we have an exit of 5 years. So, okay, you run your numbers as an underwriter. The plan is the exit strategy is in 5 years. We're going to refinance the property because this is such a good deal. Like, and this is just investor brain right now. We want to refinance in 5 years. So what we're doing when we say we want to refinance, we're going to go to a bank. Let's say we did a creative financing deal. We're going to go to a bank. We're going to refinance. That means we're going to take out a loan so we can cover the rest of the money that the seller is asking for. We're going to pay them off. Now we have a new loan. And now the amortization is different, probably a 30-year amortization. And then now have new terms.
Hold on. I'm sorry. So amortization from day one, are you saying that that would affect how much money we're paying? So if you are getting a new loan term, then let's say the new loan term is going to be another 10-year balloon. Then the amortization, if it's still 30 years, then we're still paying the same amount.
No, you won't be paying the
Like,
same amount because when we get this new loan, there's different. There's most likely going to be a different interest rate. There will also be just like Precious just said. There will also be a new amount. So the amount of the loan and the interest rate of the loan and the amortization, which is the period that the loan is for, is all going to play a part into your monthly payment.
okay. So if we had like, so let's say the original agreement has 30 years amortization and with a 10-year loan term, then once the loan term has completed, we're taking out refinance and whatnot. And then again, we have a new amount, like Precious was saying, then the old amortization term is no longer applicable, right? Like we can scratch that.
Right. It's like re-signing a new lease under new
Okay.
management. They done
Okay.
raised the rent $100, and now you have to, you got other, you gotta cover. water or whatever the case may be.
Yeah.
It's just new terms to the agreement.
So loan term should would be more important than amortization because the amortization kind of follows the loan term. And if loan term doesn't exist, the amortization, like, because if the loan term needs to be renewed, then the amortization amount is not going to be applicable regardless, right?
Remember, the loan term is just the duration of the agreement, of the
Yeah.
financial agreement. So, and the amortization is directly connected to the actual, the monetary aspect of the loan.
Yes. So that's what I'm saying. Like if the loan term expires, the amortization, because it's a money wise, and loan terms is the term that you should be paying this amount for X amount of years, right? And then the interest rate is going to be X amount, then that's the amortization comes in place. And let's say if the loan term is 10 years, so I can't not be expecting myself to, despite it can be 30 years amortization, I should only expect to pay this amount for however long the loan term is.
Right.
And then we should expect a new amount, whether it's going to be higher or lower, but normally it's going to be higher if you were to refinance the house, right? Because you or the residence,
So,
unless you have a significantly low interest.
right, exactly. And that's kind of what I was about to say because this goes into your exit strategy because every market is not going to call for you to do a refi. The point when if you're refinancing, you're hoping that interest rates will be lower. That's the point of it. Because you want like if you have a loan now, like I mean, let's just say like we're not even doing creative financing. We straight up bought a 10 unit apartment building and we went to a commercial lender. They gave us the terms, blah 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 blah, and the amortization is 30 years, and the loan term is for 10 years. We can plan to refi, which most likely that's what you're going to do because most people don't have the money to cover that the rest of that loan after those 10 years. So you plan to refi. This is where understanding the market is important. And also because if you understand the market, it's not to say that you'll know where interest rates are going to be, but you can kind of tell where the real estate market is and say, okay, lower interest rates generally means the lenders have faith in the market itself. If you got a 7% interest rate right now, you're hoping 10 years from now, looking at macroeconomics for the US, we're hoping that, okay, hopefully we can have a 4% interest rate or a 5% interest rate. So that's kind of the point of the refi. You really got to know
Mm,
the market that you're in.
mm. Therefore, there isn't a
Elsewise,
fixed time
just
for refi.
right.
It
Elsewise,
just
you
depends
just
on
sell.
the interest rate.
Yeah, you just sell. If you're not going to refi, you might as well just sell because you're going to have to pay that money back.
Okay, because I was under the impression that refi is to pay back the investors in a multifamily aspect, that they're just going to pay back the investor and then use the extra or excess equity or whatnot, or the money to reinvest into other properties. That was the impression that I was under.
Yes.
Not so much about paying back the building itself, because there are
So
still cash flow coming in.
so it depends. So if you're refinancing, you're planning on staying in the deal. Investors are in the deal as long as you're in the deal. You can't get rid of an investor.
No, but pay back their capital injected. Like let's say I paid like
Oh yeah,
I
yeah.
put in $10,000, and then what with the 5 years or 6, 7 years that they're going to refi, and then the capital will be returned to the investors, and then whatever that is like remaining will be invested into other properties, whereas there's still cash flow coming in every month. Therefore, I will be passive income then after we get paid back, essentially. So whatever the number of years is going to be.
Exactly.
Okay.
Yeah, everybody gets their money back, and then we can, if we refinancing, we continue on with the deal. Everybody has their money back, and now everybody's in the green. Hopefully, that's the hope.
Okay. The worst case scenario is that the cash flow doesn't cover the loan itself or the debt itself, or that the loan term period is up. Then if the reserve doesn't cover the loan, then we have to go for refi. Or if refi doesn't work, like the equity is not there, then we will have to for sale the property. Am I mixing things up? Because how is it if I were in the property, like if I bought the property, let's say for X amount, and I intend to sell it in refi in 5 years because the loan term can be up then the equity in it should cover the loan amount, right? Am I confusing myself?
Not exactly, because you could get interest only loan. So there will never be equity. When you're a reputable investor, you really can qualify for an interest only loan. And those loan terms can be for 10 years, for 10 years. And you'll never have equity in the deal, but that's also not that's usually not the purpose of commercial real estate. I don't Most people don't care about having equity, not in multifamily, because once again in multifamily, you got a lot of control. Now in industrial, it's a little bit different. You may want to get equity, but once again, it always goes back to your exit strategy. Because if your exit strategy is buy and hold, then equity is very important because you want to pay this loan off, right? Like usually when you're a single family home buyer and your strategy is buy and hold, you want equity. It's not even just because it's forced upon you by the nature of single family home purchases, but you want equity, especially if your strategy is buy and hold. Commercial is different. I can get an interest only loan, and this is literally a short term play. I plan on no longer having this property at the end of 5 or 10 years. I don't care about having equity in this. I'm going to get my money back. That's the play. We're going to buy this property. We're going to we're going to increase the value of it, and then everybody is going to get more money than they put in.
It wouldn't have equity in the property itself gives you more money. Like when you refi, when you have equity in the property, wouldn't that give you more money if you refi?
Not necessarily. You don't need more money to get more money in commercial real estate.
But let's say if it's residential, if I have like, let's say if I pay more, when you talk about like interest only loan, so essentially I'm just paying the loan company the interest, and then anything else goes towards a principal. Then that principal becomes my equity, should be, right? If I'm understanding correctly. And then if I were to refinance that, then that extra capital that injected or payment that I put in, that becomes like I can get more out of it because like if I were to get a refinance, right? Then the bank would give me more money because I have more capital in it. Am I right or wrong?
So with single family home, the game is different because they're
Okay.
not looking at this as a business.
But either way, if you have equity in the property when you refinance it, but you're saying that doesn't mean that you're going to get more loan out of it, even if you have more equity in the property.
Mm-mm. Not with commercial. With residential, like I said, it's different. Most of the time, you're not holding the property for 5 years because
Mm-hmm.
with single family homes, the point of it is appreciation. You want that appreciation. That's the only way you're going to make money off of this
Mm-hmm.
property. Like at the sale, is appreciation. It's not, once again, it's not the same with commercial.
Of
Like
course
you
not.
can think of it as forced appreciation. It's not really forced appreciation in the sense, but it is for that because this is a business. So we're saying, okay, we're going to go in here, we're going to raise the rents however much, and then we're going to sell at this particular price. I mean, yeah, we're going to sell for this particular cap rate, which gives us this particular price. That's our appreciation. That's the equivalent of you going in and then let's just say you have a quadplex and only one of your units is up to date. Your forced appreciation is you updating the other three. Now you just increase the value of the home, but that's forced appreciation for
Okay.
residential. For commercial, all we got to do is raise the rents. You can't raise the rents without giving them a reason to raise rents. But in commercial, you can just start
You
raising
can.
rents
Mm-hmm.
and you don't have
Got
to
it.
do much. You could say, "Oh, well the market is this," or it doesn't even matter. You could just start raising rents. I mean, look at
Mm-hmm.
industrial, look at retail. It's built into the contract. Okay, every so often your rent is going to increase 2.5%, 3%, 4%, 5%, whatever the case may be. So forced appreciation is what you think the market would be in the future. No, that's natural appreciation. Natural appreciation is you don't have any type of control. Dave, we're going to get to you. Natural appreciation is market based. Only the market can dictate whether your property will be worth more in the future. Forced appreciation is you actually going in, doing something to the property itself. So let's just say you got gas stoves in your quadplex, you put electric stoves in all of your units. You also take out all the carpet and put in all hardwood floors. You also um, you also upgrade the cabinetry. You upgrade the refrigerator. You upgrade the bathroom. You put in new shower heads. You're physically replacing stuff that's inside. That's forced appreciation.
Yeah.
So when you see
Perfect.
people coming in and they putting in new countertops, you watch HGTV, they coming in, putting in new countertop, the granite countertops, and they making things into an island. They knocking down walls and making things open spaces. Yes, that's forced appreciation. Precious had a
Why would you
question regarding why would you have a balloon payment? That goes into the seller financing aspect of things. So kind of like I remember that your loan term. Like that's kind of what that is, your balloon payment. Instead of you having a loan term, you have a balloon. With your lender being the seller or the owner, whoever it is. Sellers are not always the owner. Um, so that's why you would have a balloon payment, if that makes sense.
Okay. So, with the balloon, I'm trying to understand. So, with the balloon and everything, so it's you're saying it's pretty much the loan term. So, would it be the entire balance that you do with it?
So with the balloon, you're agreeing that at the end of, let's just say like a 7 year balloon, you're saying at the end of that 7 years, you're going to pay this amount. So that's why I said it's kind of like your loan term, but with your loan term, you're not paying the rest of the money with a refi. With a balloon, you're paying the rest that is owed on the property. You would use the
Yeah.
refi to cover the balloon payment. So, like, let's just say, for example, you get good with the seller to where you have, let's just say, let's just be super optimistic. You got no interest payment for the next 5 years. Crazy. But hey, it might happen. But for the next 5 years, all you're doing is you're paying a you're paying him or her, I'm gonna just throw a number out there, $700 for the rest. $700 on $250,000.
Okay.
At the end of that 7 years, which would be what? 12 times 7 is 84. 84 months. You now, let's do the math.
Still have roughly about 80,000 still left, if my math is correct.
Okay, so we going to trust your math. 80,000. You got 80,000 left on that balloon.
Okay.
You would use either you come up with the 80,000 out of your pocket. That's one option. You use a private money lender to come up with that money, or a hard money lender to come up with that money, or you would go get a loan, a bank loan on that property to cover that balloon payment. Does that make sense?
It's a little bit clearer, still a little bit muggy, but I can kind of understand it. So pretty much the only reason why you do a refi is try to renegotiate to spread out the payments a little bit longer, but you would be risking the term, not the terms, the interest in regards to that. Whereas if you were to go to a PML, the bank, which would be the traditional route, or either saved it because it's bringing in cash and everything, that's what you use to pay off and clearing that lender or seller.
Exactly. You're using that
Okay.
seller is giving you good terms. Essentially, that's what's happening.
So ultimately, it's almost like, okay, so the balloon payment is just like pretty much that upfront cost to actually finalize and get the ownership of whatever that property is. In a nutshell, it's your final purchase price.
Exactly.
Okay.
The balloon, you can extend it though. So therefore I was saying earlier, this is the creative finance. It's a good way because you can always negotiate with the seller or with the owner. We don't want you to wait till the last minute to negotiate. And also the reason why we want to approach creative financing on most of the deals is because when people come to you, they don't have the credibility or credit score or the income, because sometimes you get cash, right? So you may not have the paperwork to show the bank that you can actually pay. Then that's a good way to use creative financing and ask the seller to be your bank. Then you can be like, hey, I actually have this amount. Because if you were to go to the bank, then they're going to be asking all sort of questions like, what's your source of fund? Let's say Chinese restaurants, oftentimes they like to receive cash. Like they may not be recording everything that they have earned. So this is when creative
Mm-hmm.
financing can be helpful, because when you're reporting a loss on paper, then why would the bank wants to loan you money? But first is creative
Yes.
financing, as long as you can give me proof of funds. I'm not going to be asking you the source of funds. And that helps people with credit score, the credibility and whatnot. Like no official paperwork that is required, so long as the seller gets some money. That's really making their life easier. And for those people who don't have credit score, this actually helps them build up credit score because their name is still gonna be on some sort of documentation. Like again, there will be a structure if you are the seller and I haven't paid you the full amount, so I cannot be owning the property right out. And we will structure maybe an LLC, maybe a trust that have both our name on it. And there will be insurance as well, just to ensure that the seller, it's gonna be covered if me as a buyer missed a payment or two, then you have the right to take the house back without having to refund or anything. So you have the extra money in your bank and you have your house back again for you to resell if I violate any of the terms. So therefore, we want to go with balloon. Like balloon, it's great if you are in that category of people.
Okay. That's making a little bit more clear sense.
What doesn't make sense to you, if I may ask?
No, it's just I'm like, so balloon has always been one of those that has been confusing because I've heard so many different ways of it being explained. So I'm trying to unlearn what I learned and try to learn it correctly.
Okay. I understand. It's just basically the year or the period that you have agreed to upon signing contract. So like what I have shown David, the balloon was like 36 months and 700 for per month for the two houses together. The down payment's
Yeah.
90,000. So now if you confirm that you're buying the house, you're gonna have to pay me 90,000 cash. And then also the closing. So including the closing is about $120,000. So once that's done, then you're gonna pay me 700 per month for 36 months. And then once that has reached, then you're gonna have to pay me whatever remaining amount. It was like 240,000. I don't remember the exact purchase price of it, but that let's say on the 36 months, then you're gonna have to finish that payment. So therefore, if you know that you cannot afford, let's say the $100,000 remaining, then you're gonna want to do it at maybe like a year before to start looking for options to ask other people to loan you money or maybe a mortgage company or something. I'm not entirely sure about that. But that gives you period like 1 year, like the last 1 year, you should be looking out for ways to make the last payment.
Okay. Okay. That's making it a little bit more clear. I'm getting it. I'm getting it.
Yeah, and then if you cannot, because you have 1 year, because you don't want to push it to like just 2 months, then at least let's say the year before, you can't find anyone to support the lump sum, then you can come to me and say, hey, is it possible that we extend the balloon for maybe 5 more years or something? Then
Gotcha.
we can basically renegotiate the term because I may have to add interest on top of it because you're kind of late payment and it has to be beneficial to me to agree to having the extended balloon period. It may not be but at least you're giving me a heads up. You're giving the seller a heads up whether or not, like what your plan is. You should be able to figure out a year beforehand of whether or not you can get the lump sum. If not, how much time do you need to get that lump sum? Because I
Okay.
don't believe that you can negotiate for another 10 years balloon term. That's
Okay.
like maybe a 3-4 years. That's kind of the max. I mean, it's creative financing again. So also depending on your relationship with the seller too, right? Like I'm not saying never in creative financing, but just to prep your mindset that it's unlikely that they're gonna do another 10 years balloon. Like they're gonna lock
Yes, ma'am.
into contract with you for 20 years. That's kind of like they're trying to get rid of the house, right? They're trying to sell you the house,
Yes.
but then having an extra 10 years. So yeah, I hope that clears things out for you. With seller finance, the interest rate is going to be lower versus if you were to go into a traditional financing, right? Like as in like purchasing the house from day one. If you cannot pay that, then you may have to go for a loan, like another loan company before they foreclose
A
on
long
you,
line. Yeah.
right? So that would be a huge disadvantage. You may lose the house because you cannot really negotiate with loan companies. However, you are able to negotiate with seller if you're using creative financing. Whether they agree or not, that's another situation. But at least they have the right to take away your house. They may not need to foreclose on you.
Yes, ma'am. That makes sense. That makes sense.
Right. You guys have a great weekend. I'll speak to you guys soon.